Top estate planning strategies for high-wealth individuals. For high-wealth individuals in Canada, estate planning is not just about drafting a will. It is a sophisticated exercise in tax optimization, legacy preservation, and strategic asset protection. As Canada undergoes a historic intergenerational wealth transfer, the complexity of our deemed disposition tax rules, where the Canada Revenue Agency treats most assets as being sold at fair market value upon death, necessitates a proactive approach. The goal is to move beyond simple distribution and focus on minimizing the tax bite of capital gains, avoiding the delays of probate, and ensuring that a family's values are preserved alongside its financial capital. Strategic estate planning in Canada. 1. The power of deemed disposition and tax liquidity. In Canada, death is a taxable event. Unlike countries with a formal inheritance tax, Canada utilizes a deemed disposition rule, where you are treated as having sold all your assets the moment before death. For high-net-worth individuals, this often triggers massive capital gains taxes on secondary properties, non-registered investments, and private company shares. A primary strategy involves using permanent life insurance to provide tax-free liquidity. This ensures your heirs have the cash to pay the Canada Revenue Agency without being forced to sell off the family cottage or liquidate a successful business under duress. 2. Utilizing inter vivos trusts, alter ego and joint partner trusts. For those aged 65 and older, alter ego and joint partner trusts are peerless tools for privacy and probate avoidance. By transferring assets into these trusts while alive, the assets are no longer part of your personal estate and thus bypass the public, and often costly, probate process. These trusts allow you to maintain full control and benefit from the assets during your lifetime, while ensuring a seamless, private transition to your beneficiaries. Because the assets never enter the estate, they are also better shielded from potential wills variation claims or creditor disputes. 3. Estate freezes for private corporations. If a significant portion of your wealth is tied up in a Canadian-controlled private corporation, an estate freeze is a foundational strategy. This involves freezing the current value of your shares in exchange for preferred shares, while issuing new common shares, which capture all future growth, to your children or a family trust. This locks in your terminal tax liability at today's value and shifts the tax on all future appreciation to the next generation. It is a powerful way to manage the eventual tax bill while keeping the business within the family. 4. Charitable giving and donor-advised funds. Philanthropy is a cornerstone of high-net-worth planning, offering both social impact and significant tax credits. By donating publicly traded securities in kind to a charity or a donor-advised fund, you eliminate the capital gains tax on the appreciation while receiving a donation receipt for the full market value. A donor-advised fund acts like a private foundation but without the high administrative costs, allowing you to claim a large tax deduction in a high-income year while granting the money to charities over time. 5. Managing probate with multiple wills. In provinces like Ontario and British Columbia, where probate fees, estate administration tax, can be substantial, the multiple will strategy is widely used. By creating a primary will for assets that require probate, like bank accounts and real estate, and a secondary will for assets that do not, like private company shares and personal effects, you can save tens of thousands of dollars. The secondary assets pass to heirs without the need for court certification, keeping the value of those assets, and the details of their distribution, entirely out of the public record. 6. Income splitting through family trusts. While the tax on split income rules have tightened in recent years, family trusts remain a viable vehicle for income splitting and capital gains multiplication. By naming multiple family members as beneficiaries, a trust can allocate capital gains to children or grandchildren, who may be in lower tax brackets, potentially utilizing their individual lifetime capital gains exemptions on the sale of qualified small business shares. This not only reduces the immediate family tax burden but also facilitates a structured distribution of wealth over time rather than a single lump sum inheritance. 7. Life insurance as an asset class. Beyond providing liquidity for taxes, high-wealth individuals often treat life insurance as an independent, tax-exempt asset class. Through corporate-owned life insurance, a business can build cash value that grows tax-sheltered. Upon death, the proceeds are paid into the corporation's capital dividend account, allowing a significant portion of the death benefit to be flowed out to shareholders as a tax-free dividend. This is one of the most efficient ways to extract wealth from a corporation while minimizing the double taxation that often plagues business owners at death. 8. Protecting against cognitive decline and incapacity. A truly comprehensive estate plan must account for life before death, specifically, the risk of cognitive decline. High net worth individuals face unique risks regarding the management of complex portfolios or businesses during incapacity. Modern planning includes robust enduring powers of attorney and healthcare directives that do more than name a substitute. They provide specific guidance on investment philosophy, business management, and even philanthropic continuity. This ensures that your financial legacy is protected even if you are no longer able to oversee it personally. 9. The importance of regular reviews and family governance. The final, and perhaps most vital, strategy is the implementation of family governance and regular plan reviews. High-wealth estate planning is not a set-it-and-forget-it endeavor. Changes in tax legislation, like the 2024 capital gains inclusion rate changes, shifts in family dynamics, or the birth of grandchildren require a living plan. Successful families often hold family meetings to educate the next generation on the responsibilities of wealth, ensuring that the transition is not just legally sound, but also socially and emotionally successful. To learn more about our law firm's estate planning legal practice, we welcome you to visit our website or contact our law firm to schedule a confidential consultation. Thank you.